Hello and welcome back to Principles of Accounting 2. I am still your host, Dr. B. Happy to have all of you with me today. My sincere apologies about being away last week. I was at a conference all week, and let me tell you something, those meetings were never ending. So I missed you all, and yeah, it was just one of those kinds of weeks. But again, I apologize about last week. I did post a pre-recorded lecture from last semester. I put that in the announcements area. The good news is it's the same exact chapter. It hasn't changed. It's all the same stuff. Um, that's why I do that, right? Just in case. But again, I apologize about that sincerely. I'm happy to be here today, though. We are in the 11th week of this course, if you can believe that or not. We're almost toward the end. We got 2 more weeks of lecturing to get through. That's not a lot. We're going to be done with this course pretty quickly. Because this is a Principles of Accounting 2, and some of you are graduating this semester, we will have our final exam toward the last week of April. So there's that. So that's an important thing to remember. So again, we only have after this week. There's 2 weeks left of lecturing, and then the final exam will show up toward the end of April. Because some of you are graduating this semester, so we've got to make sure that everyone gets a chance to take the exam at the same time. So we are in the 11th week in the classroom, so under Module 3, Week 11. The PowerPoint, the exercises, and then, a different kind of homework assignment for this week. These are essay questions. Oh, Dr. B, what are you doing to me? Oh, essays. Oh, I don't do well with essays. That's okay. You don't have to be an expert writer. So it's all right, okay? There are a couple of essay questions that I need you to respond to by Sunday night. In thinking about this, there are 5 questions. They are all relatively more driven by definitions, mostly. Okay, I promise you, it's not difficult. You don't have to. It doesn't have to be many paragraphs or things like that. Just a couple of sentences for each question. Like 3-4 sentences for each question. That should do it. Okay? That's the type of homework assignment we have for this chapter. Wanted to change things up. It got a little boring before, so this is something different. Let's talk about the concept of performance management and responsibility accounting. Performance evaluation. Companies are structured in different ways. It depends on the size of the company. For a large company, there might be what we call divisions, segments. Most of the time, we call them departments. And each department is responsible for a function of the business. Human resources is responsible for hiring, payroll, training, etc. Right? That's human resources. Your accounting office is responsible for accounts payables, receivables, budgeting, etc. Your sales department you might have multiple areas in sales. For example, if we're talking about a large company like Macy's, one of my favorite retailers, Macy's. Macy's has a lot of departments in their store. They have the jewelry department, women's clothing, men's clothing, housewares, children's clothing, etc. a lot of different departments. Each department has 3 measures that we use to evaluate the success of that department. These 3 measures are broken out into what we call centers. The center is a form of a measurement for each respective department. We have cost centers, profit centers, and investment centers. A cost center identifies how well the department is at managing their controllable costs. Successful they are at managing their controllable costs. The key word here I want you to take away is controllable. Cost centers are evaluated based off their success in controlling cost. Controllable costs are costs that can be controlled by the manager of that department. There are controllable costs and uncontrollable costs. Controllable costs are the costs that can be controlled by the manager of that department. They have the foresight and the oversight of the respective costs for that department. For example, say the Macy's jewelry department has employees. They have the cases where the jewelry is displayed. And of course, then they have the jewelry. And they have a couple of other various things in their department, right? Everything within that department, for the most part, is a controllable cost. The manager can control employee wages, the number of hours that the employees are working in that department are controlled by the manager of that department. The amount of product used to clean the glass cases is controllable. The manager can control the cost of cleaning products for that department. The manager can control the amount of inventory carried in that department. The manager can control other things that happen within that department. Those are what we call controllable costs within the cost center. So the jewelry department is evaluated based off of their success to control their controllable costs. The jewelry department is also evaluated based off of their ability to generate income. This is called the profit center measure. Profit center measure helps to evaluate the department based off their ability to generate income. This comes from the sales. In our jewelry department example, it's based off of the jewelry department's ability to sell their inventory to help the company to generate a profit, to help the department to generate income. So as a store manager, I would evaluate my department manager's performance on their ability to both control their costs and generate an income. Now, there might also be another measure called an investment center. Typically, an investment center covers the entire store, not just an individual department. The investment center is where the store purchases assets, invests in assets like equipment, inventory, a new building, capital expenditures, right? The store invests in assets to help the department and the store generate income. We call that an investment center measure. So these three performance centers helps us together to evaluate the entire performance of an individual department and ultimately the entire store when they're collective. I had mentioned earlier the idea of controllable and uncontrollable costs within the cost center. Controllable costs are those that the manager of the department has the ability to control. Hourly wages of the employees working in the department. Inventory on display within the department, the displays themselves. Other components within the department. The manager of the department has the ability to control these costs. Okay? There are also uncontrollable costs. These are costs that are outside the purview of the department manager. The department manager has uncontrollable costs assigned to their department. This would include things like utilities, the electric used for the entire store, not just for the jewelry department. It's hard to allocate things like utilities to one department. We, of course, can do this by using the square footage of the department and allocating it that way. Depreciation expense is an uncontrollable cost. The department manager of the jewelry department cannot control depreciation of the building. That cost is associated for the entire building. It's uncontrollable, you see, for the department manager. So what happens is that the depreciation expense total is divided by the total square footage and then multiplied by the square footage of the department, and that cost is assigned to the department. Uncontrollable because the department manager cannot control that. And then, of course, the department manager's own salary is an uncontrollable cost for the department. The department manager cannot set their own salary. That is set by the store manager or corporate office. See? So therefore, this department manager's own salary is also considered to be an uncontrollable cost for the department. It's very important that within our accounting system, we have the ability to identify the responsibilities of individual managers, which ultimately helps us to evaluate their performance on their ability to control things within their department. Responsibility components include the ability to control controllable costs and the ability to generate revenue or income. Responsibility accounting is organized based off of the hierarchy of the company. For a large company like Macy's, for example, they have several different departments within the store. The store belongs to a region. The region belongs to a country. And the country belongs to the president. and then ultimately the board of directors. See, this example, it looks like this is a food and beverage company. This food and beverage company is designed by department. Everything starts with the board of directors, who is ultimately responsible for the company's performance. President is responsible for the day-to-day operations of the company. Vice presidents throughout the globe report to the president. There's an executive vice president for each geographical area on the planet. Each geographical area is broken down into regions. Within each region, we have managers of individual departments. See, so responsibility of controlling costs and generating revenue falls within several different levels of the organization. The amount of detail we can see depends on how close the managers are to the products and to the customers. This is a very simple concept to understand. The department manager has the ability to see a granular level of detail for their department. For example, the jewelry department manager at Macy's has the ability to see how well each of their jewelry line items, jewelry SKUs, jewelry, whatever you'll call them, how well each of them are selling. How well are my watches selling? How well are my bracelets selling? How well are my rings selling? How well are my etc. Department manager, the jewelry department manager, has the ability to see how well each of their items are selling. They also have the ability to see all of their controllable costs, such as employee wages that work within the department, the consumption of cleaning products, the use of lighting, etc. List goes on and on. The department level manager sees a very detailed level of reporting. You can see everything line by line. Okay. The store manager, on the other hand, only sees a summary for each department. When a store manager receives the report for the jewelry department, all they see are the total sales, the total income, and the total expenses. That's really about it. The store manager is not concerned about how well a watch is selling in the department. They're more concerned about how well the entire department is functioning as a whole. Right? The store manager's only concerned with the responsibility centers of the department manager, the cost center and the income center, you see. The store manager receives a summary for each department, so they only see the income and the expenses for every department within the store. They see the summary. Very small amount of detail. And then, of course, the regional manager sees even less. All they see is just the store income and expenses. And then the vice president of the country, that all they see is the bottom line for the whole region, right? You see, every level that you go up, the less detail is seen. So the way to remember this is the closer you are to the customer and to the product, the more detail you can see. And here's an example of what I had just mentioned. Looking at the Example of a company that does both food and beverage. Within the within the beverage department, we have direct labor, direct material, factory overhead. We can see all the detail for those things within the department. Information rolls up to the region. But it doesn't roll up with all the detail, it only rolls up with the totals. Because the regional manager, they don't care about what was your direct labor in for your store. They don't care about that. They care about the bottom line, the totals. Okay? Then, of course, the level above that, they see even less detail. They only see the region's totals. But you see how it rolls up. So again, the closer you are to the product and to the customer, the more detail you can see. When we look at these cost centers, it's also important to understand the differences between direct and indirect expenses because it's important to understand where those controllable costs are. Remember that there's controllable costs and uncontrollable costs. The department manager has the ability to control the costs within their purview. They cannot control things that are assigned to their department outside their department. Direct expenses are costs that can be directly traced to that department. The employee wages working in that department, working within that department, that are specific to that department, etc. Can be directly traced. Other costs can be directly traced to that department. That what we call as direct expenses. Indirect expenses are all of the other costs that cannot be directly traced to one department. We call these joint costs. Joint costs. There's a couple of these. The store manager's salary. Store manager is ultimately responsible for the entire store. They have a lot of different department managers that work under them. But ultimately, the store manager is responsible for the entire store operations. Department manager, they have a direct expense. Their salary goes directly to the department. Store manager's salary does not. It's an indirect expense. So the way a store manager's salary works is we take their total salary and divide that by the number of departments. Typically. It's usually based off a number of hours worked in each department, some factor thereof. Rent is another example of an indirect expense. The rent for the entire store can't all go to the jewelry department. That wouldn't be fair. So we allocate rent. We take the total dollar amount of the rent, divide it by the total square footage, we multiply that by the square footage of the department. That's how we allocate rent to the department, indirectly. Utilities, electric. The jewelry department's not responsible for the electric bill for the whole store. They're only responsible for their square footage of their department. Utilities is an indirect expense. Advertising expresses a percentage of sales for the department. And depreciation, based on the hours of the asset used, allocated to the department. Joint costs, direct expenses. So indirect And service department expenses are allocated across departments that benefit all of them. We use a cost-effective relation to allocate expenses. If there's no cause-effect relationship, we allocate based off of the approximation of relative benefit that each department receives. A lot of cute words. Okay. At the bottom here is the real formula. We take the total cost to allocate and we multiply that by the percentage of the allocation base used. Sounds complex. It's not that bad, I promise. Let me show you how it works. After I talk about service departments, of course. Service departments are the departments that benefit all of the other departments. A service department includes things like the human resources department, the office, the back office, right? The sales department, the accounting office, purchase department, which is part of the accounting office, and of course maintenance. The repairs maintenance department, they take care of the whole store. Yeah. So office expenses, payroll expenses, personnel, purchasing costs, maintenance expenses, all these are examples of expenses that come from service departments. Think of a service department as a department that services the entire store, not just one individual department. Service department would include examples like human resources, accounting, the sales office, the store manager's office, etc. We use an allocation base to allocate the expenses that come from those service departments. So we have indirect expenses and service department expenses that we allocate to the individual departments based on common allocation. Oh, I love this example. So happy to use this example. It's a jewelry department, okay? The jewelry department at my store, classic jewelry, we have janitorial services. Very nice. Company comes and they clean the store, the whole store. Oh, that's so nice of them. First, we got a big store here. Our store's huge. It's 4,000 square feet. That's a big store. Okay. We sell jewelry, watches, china and silver. We also have a watch repair department. That's cool. So, here's how it works. We received a bill from the janitor services. They come and they clean our store every month for $800. Okay? They vacuum the carpets, wipe down the glass, etc. Make the place look nice. Because it's a service, it's a service department servicing the store, we allocate the cost of this service to each department through what we call cost allocation. And here's how it works. The bill is for $800 for the month. So we know that we have to allocate a total of $800. We allocate this based on, here's the basis, total square feet of each department. The total store is 4,000 square feet. The jewelry department is 2,400 square foot. Watch repair is 600 square feet. And china and silver is 1,000 square foot. a total of 4,000. We can convert this into percentages. 2,400 square feet out of 4,000 is 60%. All I did was 2,400 divided by 4,000 to get 60%, right? 0.6 multiplied by 100. Repair, 600 over 4,000 is 15%. 1,000 over 4,000, of course, is 25%. So 60, 15, and 25 equal 100. Now what I do is I take the $800 and multiply that by the percentage. So 800 times 60%, that's $480 of cost I allocate to the jewelry department. $800 times 15%, that's $120 I'm allocating to the watch repair department. $800 times 1,000 25%. I was going to say, wow. $800 times 25%, that's, of course, $200 that I allocate to the China and Silver department. For a total of $800. That is how we allocate an indirect expense that came from a service department. See? Questions at all on this concept of cost allocation? I do okay? I'll understand the concept. Still awake? I know it's not that exciting. All right. Thank you, Zarya. Okay, cool. Thank you so much. Just as I can do for the entire company or for the entire store, I can prepare an income statement for each department. It tells me exactly how much sales and expenses each department of the company, the store, has contributed. So here we go. We take the revenue and expenses from the department. And we also take the total indirect expenses. And we allocate those total indirect expenses across both service and operating departments. Then we allocate the service department expenses to the operating departments. That's the whole thing of allocating that we talked about earlier with that jewelry store example. And then we prepare the income statement for each department. Very straightforward. Of course, we would want to do that using a spreadsheet. Ideally, it should be done using some accounting software like QuickBooks or Sage 50 or Oracle or one of the many other ones. So here is step one. We find the direct expenses and the indirect expenses. We can see that the direct expenses we've allocated to each department directly. We allocated sales for each department. Then the direct expenses, cost of goods sold, the salaries for each department, depreciation of equipment, and supplies. Those are all direct. Indirect expenses include things like rent, utilities, advertising, and insurance. In step two, we're going to allocate. Step two, we allocate those expenses across. Now, how do we do it? It's based off of the allocation base, remember? The allocation base for rent, of course, is going to be square footage. Utilities, also square footage. Advertising expense is allocated by sales. And the insurance expense is allocated by the value of the assets insured. Makes sense. Then, also in the same step, or technically step three, we allocate the service department expenses to the individual operating department expenses. As you see down here with this nice little red line and the arrows, we took $15,300 and allocated that respectively to each of the sales departments: hardware, housewares, and appliances in this example. Took general office department and we allocated based off of the sales amounts. Now, how do we do that exactly? Basically, all we did is we added up all the sales from each department and we found the percentage of sales from each department. And that's how we allocated that dollar amount. Kind of like our earlier example in our jewelry store. And I did the same thing for purchase orders. The purchasing department expenses were allocated based off of the number of purchase orders that came from each department. Then in step 4, I create the income statement for each department. Sales minus cost of goods sold equals gross profit minus all of your expenses equals operating income. See, very straightforward. We can find exactly what the contribution margin from each department looks like. The way we do that is we take the revenue minus the expenses to find the contribution to overhead. Contribution margin is used to evaluate the performance of each department. If there's something that's not functioning properly, we can address it. Sometimes that's why you see certain departments disappear from a department store. If they don't do well, they're not going to keep them around. It's kind of like when, long time ago, when Sears was really big, they had a lot of different departments, and one of those was the electronics department. They didn't do so well for a couple of years. And because it kept losing money year over year, the company decided, you know what, it's time that we got rid of that department. So they eliminated it. Happens. Yeah. Department contributions are emphasized, of course, because it's important to understand the contribution margin from each department and understand if it's generating true revenue for the store. Earlier on, I had mentioned the concept of investment centers. We talked about the cost centers, controllable costs, uncontrollable costs for the department. We also talked about the profit center, the department's ability to generate income. The last parts I briefly touched on investment centers, and that is where the entire store purchases assets that are used to help the company to generate income. Individual department managers are evaluated based off of this, but it's really the store that's evaluated based off of this concept. We look at things like the return on investment, residual income, profit margin, and investment turnover. Of course, all of these are ratios that we use to calculate to determine the overall performance of the department. The return on investment is calculated by taking the income divided by the average invested assets. To find the average invested assets, we typically take beginning assets plus ending assets divided by 2 to find the average. So we can quickly identify what it is for each division or each department by taking the income divided by the average invested assets to find our return on our investment. The higher the return on the investment, the better. Yeah. We also look at things like residual income. This is the additional sales dollars that are earned based off of a target investment. Here we take net income and subtract the target investment net income. And this tells us the residual income. How much additional revenue did I earn after the initial investment? Okay, and then of course, profit margin and investment center turnover. Find the ROI. We look at profit margin and investment turnover. Profit margin, as you recall from a few weeks ago, we talked about profit margin. We looked at income divided by sales to find your profit margin. Find the investment turnover, we take sales divided by average assets. Okay. One of the most commonly used approaches to identify the company's stability is called a balanced scorecard. The balanced scorecard takes costs and revenue, so financial and non-financial information, into consideration. So we look at this from 4 perspectives: customers, internal processes, research and development, and financial data. So we look at financial and non-financial information to understand the overall stability of the company. From a customer's perspective, we look at things like customer rating, number of new customers, on-time delivery percentage, percentage of sales from new products, time to fill orders, percentage of sales returned. List goes on and on. It's not just these, but just kind of gives you a snapshot of the information we look at from customers. And then from internal processes, we look at things like amount of defects, cycle time, product costs, labor hours per order, days of production without an accident, etc. R&D, we look at things like employee satisfaction, employee turnover, the amount of spent on training, the number of new products developed, number of new patents, the amount spent on research, etc. Then from financial information, we look at things like the net income, return on investment, sales growth, cash flows, residual income, stock price, etc. This goes on and on. The balanced scorecard approach gives us an idea of the company's stability over time. I always look at this kind of information before I make an investment decision into any company, because it helps me to really understand the company's ability to maintain stability. Within larger companies, oftentimes, if a company runs out of inventory, or if another part of the company has produced too much inventory, there might be what we call an internal transfer. An internal transfer occurs when one department doesn't have enough inventory and another one has too much. And so the 2 department managers from the 2 different stores might call each other and say, "Hey, I ran out of inventory. Hey, I have enough. I'll be happy to ship you some to your store." We call it an internal transfer. We're taking inventory from one store and transferring it to another in order to accommodate the inventory needed for operation. Along with this transfer comes a concept called transfer pricing, which I'm going to talk about very briefly. Don't worry, I'm not going to have you dive too deep into transfer pricing, but I just want you to understand what it is and how it works. Transfer pricing occurs when there's a negotiation between both managers from both stores as they talk about the price per unit to get it from one store to another. Transfer price. We look at things like the sales price, variable cost per unit for manufacturing, and total fixed manufacturing cost, and the total production capacity. Based off of this information, the typical transfer price lands somewhere between the maximum sales price and the variable cost per unit. Don't worry too much about transfer pricing in this course. It's a very complex subject. For those of you who are accounting majors, you will be diving deep into that when you get to your cost accounting course. A couple of more important measures, ratios that you need to know. Our cash conversion cycle. This tells us how long it takes us to convert cash outflows and inflows from our customers. How quickly the company can get some cash coming in is the reality, right? Calls cash conversion cycle. We take the days sales and accounts receivable plus the days sales and inventory minus the days sales and accounts payable. Each of these three items are their own formulas. So this formula will take some time to calculate, as you can see, because it's really three formulas in one. Sounds complex. It is, but it's really not as bad as it sounds. You just do one at a time. Days sales accounts receivable, we take accounts receivable divided by sales times 365 days in a year. Days sales and inventory, we take the inventory divided by cost of goods sold times 365 days in a year. For the days sales and accounts payable, we take accounts payable divided by cost of goods sold times 365 days. So you do one at a time, and then you just plug those numbers in to the equation, and that will give you the cash conversion cycle. Here's an example of what that looks like. I apologize, this is a little blurry. But the cash conversion cycles, you really want to try to shoot for a lower number of days when it comes to cash conversions. Allocated cost is the total cost to allocate times a percentage. The allocation base used. We do this for things like rent, utilities, advertising, and insurance expenses. Very similar to the example that I walked through earlier. Department allocation base is based off of square footage, dollar amount value insured, numbers, amount in sales, and the number of purchase orders. How do you allocate rent? It's based off the square footage. So take total rent divided by total square footage, and then you can multiply that by the number of square feet for each department. Same thing for utilities. Based off of the square footage, take the total utility expense, divide by square footage, multiply it by square footage per each department. For advertising, it's based off the advertising expense and sales dollars from each department. For insurance, it's the value of the amount insured from each department. And then of course, we already know how to allocate service departments. We talked about that in our earlier example. More of the same. We talked about transfer pricing, the negotiation between the two department managers. When it comes to transfer pricing, the key thing to remember here is that the transfer price is anywhere between the maximum market price, the sales price, and the variable cost. Usually close to the sales price stuff. Typically. Transfer price is usually typically the sales price. But again, don't worry, I'm not going to have you get too deep into transfer pricing. At least not in this course. And then, of course, we also talked about the concept of joint costs. This would include things, and the better example than this would include the store manager's salary. That's a joint cost. The store manager's salary gets allocated to each individual department based off of the salary, of course, and the amount of hours each employee worked in each department. I'm not going to have you worry about too much about that stuff either. Got the idea from the earlier examples. These later examples aren't as good. We made it to the end. Oh my goodness. Are there any comments, questions, or concerns about responsibility center accounting or cost allocations? Is there anything that questions you have about these concepts? We do okay. Yeah, thumbs down, not good. Thumbs
Yeah, I'm good.
Questions good.
No, I was saying no questions, Professor.
Oh, okay. Okay. All
But
right.
you did great as always.
Oh, thank you so much. You're all fantastic. You guys are great. I always enjoy having you all in class. You keep me entertained. The nice thing is with Principles of Accounting 2, and hopefully you're all noticing this, is that it's a lot smoother than Principles of Accounting 1, right? A lot smoother, I think.
Yes, it is.
Yeah, a lot more straightforward. Okay. So just as a reminder about the homework assignment for this week, it's different than in previous weeks, okay? So this one is essay questions. Don't get too excited. It's okay. All I'm looking for here is like 3 sentences for each question. There's only 5 questions. They're definition based. So ideally, if you can try to get this done by Thursday, that would be awesome. As long as it's done by Sunday for sure. But my recommendation is to try it on Thursday during our class time, so that way, if you have questions, you can always send me an email and say, hey, Dr. B, I don't get this. So that way I can help you before it's due, right? That's always the best notion. And of course, if you ever need help with anything, you know that you can always email me, call me, set up office hours, whatever you like. You know, I'm here for you. I'm always quick to respond to email. You can always set up office hours with the link right here. Whatever you need, you know. I'm here for you. So if there are no other questions, I want to thank all of you so much again for your hard work in the course so far. I know it's been a long journey. We're in the 11th week together. We're almost there. We're almost done. We got a few more weeks to get through, and then we'll be done with the course. And I'm so proud of all of you. You're doing very well. You're all passing the course so far, and that's excellent news. Very proud of all of you and all of your hard work. If for whatever reason, if you have something that's still outstanding, you know, maybe you didn't get a chance to submit the homework from last week, please make sure you do that. You don't want to miss anything in this course because it's really, really, really important that you stay on top of the work and that you submit all of the work, okay? Because I care about you. I care about your success in this course. And, you know, it's important to me that I see you do well. I want you to do well, okay? So with that, If you need anything, please get a hold of me. I'm here for you. And thank you all so much for your time tonight. I appreciate all of you. I appreciate your hard work. Keep it up. We're almost there. I know you'll finish strong. And with that, I want you to stay safe, wash your hands, do the right things, and I'll see you all again next time. Thank you so much. Appreciate you.
Thank
Take
you so
care.
much, Professor.